Hello, I'm looking at problem 11-27A in the textbook. In the back of the chapter, what we call the static problem. This doesn't change; it's already printed, as opposed to what you see in my lab, which is already algorithmic. So it's the same problem but with different problems. So I'm using the one in the back of the book, and I'm also showing you the answer key for those transactions. As you can see, this is all related to current liabilities, and it shows several transactions in 2017 and one more in 2018. The first one is the purchase of equipment at $12,000, 6-month note at 9%. So in the first case here, that's what you see here, the journal entry showing you increase equipment by 12,000 and you have a liability of 12,000. On the 29th, you've got a sales of 62,000. 3/4 of it of these sales are on account, meaning receivables, because you're the one giving credit to your customers, and then 1/4 of these sales are in cash. Now, related to those is the amount of sales tax you're going to be charging. The people that pay you that pay you in cash, they're going to pay also 6% on that portion, 1/4 of the sales, as sales tax, and then the remaining amount is also 6%, but they're going to be part of the receivable. And so that's how you end up with these amounts for that transaction on the 29th. On the 5th, you're sending what you figured was your sales tax payable for that account, for that transaction previously on the 5th. So about a week later, you send it to the tax authorities. So you're going to reduce and eliminate your sales tax payable by a debit and creating your cash for the amount you pay out. On the 9th, you're now paying off the initial note that you set up in 4 months, or actually I guess 6 months earlier, on January 9th. So on the 9th here, you're going to get rid of the note payable of 12,000, and then you're going to figure out what is the amount of the interest that you have to incur for those 6 months. So if it's the principal of 12,000 at 9% times 6/12. In this case, we'll be using months. So 6/12, half of that, it's half of the 9% times 12,000 gives you 540. So that's the amount of interest expense. So the amount of cash paid out is both the return of the principal of 12,000, the return of the loan basically, and the 540 interest. On August 31st, you purchase I guess more merchandise, in this case inventory, 9,000 with 10% note over also 6 months. So again, you're gonna actually book the inventory, and then you set up the note payable on the 31st. In next transaction, the 31st, is warranty expense. They just simply give you that you're going to be using percentage of sales. They give you 4% times the sales of 609, and that will give you a total warranty expense liability of 24,360. On the 31st, the next and to last transaction, you're doing the accrual of interest for the note here on the 31st. So this relates back to that transaction. So in that case, as you might remember, we borrowed 9,000. The interest was 10%, and we've incurred 4 months of interest. From August 31st to December 1st, it is 4 months. September, October, November, December. So that's when we have 4/12. The interest expense accrued and not yet paid at the end of this year is $300. That's when we have an interest payable here and not cash, because we haven't paid it yet. And then eventually, after the year end, we actually finally pay off that payable, or I'm sorry, that note. So we're going to get rid of the note payable of 9,000. We're also going to get rid of the interest payable that we set up here in the previous transaction of $300. And then we also have to then book the additional interest from the end of the year to February 29th. So 2 more months, 9,000 note payable, 10%, and 2 months. That gives us $150. total cash paid out for that transaction for the payoff of that note payable would be $9,450.